ready to go.
Okay.
So, okay, showtime?
Showtime.
Okay. Welcome back, and thank you for participating in our presentation that we did yesterday. We talked about a number of things, and one of the key things we spoke about, and I ran over very quickly, was sellers' discretionary earnings. Remember when we were looking on the websites for different businesses? And you're going to find in our industry that there's a whole lot of things in the business broker industry, people that are going to help you buy that right business to change your life. You're going to find a whole lot of things with new initials, SDE, NDA, CIM, and after a while you might even say, wow, WTF, which my kids all know means, wow, that's funny. And you're going to find there's a whole lot of wow, that's funny as you start looking through the financials of business owners in that real world. Now, who likes to pay a lot of money for taxes?
No way.
Right? No arms are up here, just so you know for the screen and watching this online. Most business owners don't want to pay a whole lot of taxes. And if you had the opportunity to legally pay as little taxes as possible, would you want to do that?
Yes.
All right, now for business owners, legally is an option for some of them, but they still want to pay as little taxes as possible. So our job is to look at the financials. And you, when you want to decide on buying a business, want to make sure you're making enough money and that they're making that same amount of money that they're claiming. So we're going to talk a little bit about how you go about looking at the financials to determine if you're making the money that they claim. It's sort of like a recipe, you know, hey, you got a cake, this is a cake, and you want to make sure all those things are in there. So we're going to look at the recipe and look through the details. I'm going to skip over that slide because it's details, but that's the actual formulation, and we're going to go through all the different elements, like the recipe, on how to bake that cake, or in this case, how to determine the owner benefit. SDE stands for Seller's Discretionary Earnings. You might see DE for Discretionary Earnings, and there's a whole lot of initials as I explained before. So the first thing, first of all, at the bottom line of a tax return or a profit and loss statement, you're going to see this number. Let's say the owner says he made $200,000, okay? And you say, oh, I want to buy this business. I'd like to make $200,000, and I might even improve upon that. And you get the tax returns, and you look at the bottom, and it shows $20,000. And you say, what? And you say, I need to understand that. So we're going to help you determine if that person is really sharing that information properly or lying about that information, and you need to get some work. Now, one of the things I always recommend is you get a professional accountant to get some help no matter what. Does that make sense to you?
Yes.
Right? So you want to make sure that you have somebody to help you through the process, because even if you think you feel pretty good about it, you also want to make sure that you're getting the type of support, because it's a big deal, right? So who here is still looking to buy business? Everybody involved in that? Anybody got an industry that they want to acquire business in, by the way?
Yes, I do.
Luke, what are you thinking about these days? You have got an industry picked out, or a number you're looking for, or what?
I would like to buy a car wash.
A car wash, okay. One that works all by itself so you can stay at home, or one you want to be scrubbing and doing the car wash blues like
A little bit of both.
a little bit of both. Those are very profitable, very, very good. So car washes are like everybody else. You know, they've got this earnings, and you got to find out what's going on. If a working owner is working in the business, then you need to determine, hey, am I going to work in the business, or am I going to stay home and make money? Are you going to work in the business and do that, or are you going to keep your other job and look at a car wash as a side element?
I'm young, I'd like to work.
Good, 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 good. Anybody else feel that same way, that you could work in the business? Okay. Now, here's the one thing that we do. We usually look at seller's discretionary earnings as this number that we're going to add together. We're going to add all this stuff together and make that recipe. Right, April, the $20,000, and now we're looking at the recipe of what the owner's working. But what if the owner says, I got my wife, my 3 kids, and we bring home $300,000 into our household? Well, unless you're going to take the wife, the 3 kids, so they can move in with you and work for free and give you all that money, we can't count all those people. We're just going to count you, one working owner, right? Does it make sense?
Yes.
Tanya? No. Hold it? Okay. I'm just messing with you here. Anyway, so we
I
want
can't
one
even get
working
my son
owner.
to wash his own car.
That's right, that's right. So it's important to determine who's getting paid for what. And if those other family members are working in there and they're talking about, oh, we're making this money, you're going to have to say, well, I have to replace the wife and the 2 kids. So you need to go back and maybe get some help from a broker or the accounting to determine and say, how much do I have to pay to replace the wife for shining the cars up and the kids for, you know, doing the soap replacement, that sort of thing. So it's just one working owner. Don't let anybody take you. There are these things called non-reoccurring income. Now you see on there BP oil spill, all these different things out there. The reason you take something that's on the financials away, and I had this with a gentleman one time, he had a restaurant, and he had $75,000 as a line item. Turned out he'd won a lot of money in the lottery, and he threw that on there. I don't know if that's right or wrong, no legal, no accounting advice given here, but you need to adjust that so it makes a lot of sense. So can you think of anything that would be a non-recurring income if I told you BP oil spill or winning a lawsuit? Can you think of anything else that might be involved in something like that that you would see on the financials and say, wait a second, I'm probably not gonna make that type of money? Any ideas at all?
In non-recurring would be subleasing property, for instance.
Okay.
Suppose you're subleasing property, you put the money in there, that could be non-recurring.
Perfect.
Because you're not selling the property, you're just selling the business.
Excellent.
I would say PPP money.
PPP is an excellent one out there. And you'll see a lot of people say, hey, I made another $60,000. Well, Uncle Sam or whomever is not going to be giving $60,000 out to everybody. So you're exactly right, both of you. Thank you very much for that. There's also non-reoccurring expenses. So imagine I've gone to work with a client and they said this is a 40-year-old business that needs a lot of love and care, and the owner says, you're right, they spend $50,000 one time to fix up the showroom. When you buy the business, it's already fixed up. Do you think you're going to spend another $50,000 coming up next year or the year after to remodel the showroom?
No.
All right, so we're going to take that and say, well, that would be part of the money that you could get. So $50,000, or whatever that number would be, you'd say, well, we're not going to have that every single year. And again, we're doing a high level. On our next session, we're going to go through and do an actual example. But I just want to get the questions into your head. So what happened to my screen? 1, 2, 3. Okay, there are certain things that the government allows you to minimize on your taxes. So you don't have to pay, nobody writes a check for depreciation or amortization. But Uncle Sam has been gracious to say when you buy things, you can sort of write those amounts off in different details, and that goes back to your pocket. So if they've written off another $50,000 for depreciation for all this great equipment, or a really super concrete machine mixer and that sort of thing, that is money that really goes into your pocket. You can save it a little to buy other stuff later on, but we're adding another bit of money. And there's another thing called amortization. It's sort of like that. Anybody know what amortization is? Have you heard the term before? Comfortable with it? Depreciation is physical things. Amortization is the stuff you don't really touch. It's like franchise costs or something like that. Okay? So now we're going to go back to one of the things, and Aldrin, you actually brought this one up, but there's also, and I've broken it down to different categories, non-operating expenses. And again, we're going on a high level on this thing, but suppose the owner has been renting out to his son-in-law all the stuff for his grunge rock metal band, and that son-in-law you don't probably want to have staying with you when you take over the business. That kid's going out, that $500 a month isn't going to be coming into your cash flow. Does that make sense to take that back out?
Yes.
And then non-operating expenses. This is one of my favorite ones out there because people say, yeah, you got to add this stuff. No. The guy that has a non-working spouse. She used to work in the house, or he used to work in the business, making $36,000 a year, and they decided they really don't need him or her in the business. But that person loved getting that $36,000, so the business is writing a check to Dean, who's now not working the business. That money you won't have to spend because Dean's not going to be collecting $36,000 after you take over, right? So I see one of the categories is things like meals, right? So let's talk about that for a second. Let's say there was the owner, he says, I got $10,000 a year in meals. My wife and I are going out all the time, and that's la, la, la. Would that make sense to add back as part of the determination of the earning of the business or not? Meals. Is that necessary for the business for the owner to go out and eat at Chick-fil-A every single week?
No, it's not. I'm thinking it's something you can add back.
It would be an add back. Now, let's say the same thing is happening every month. The owner spends money on meals to celebrate victories in the business and to win over new customers. Would that be an add back? Do you understand the difference out there? So sometimes you got to look a little deeper into it. And that's why I encourage you to go get the accountant and get help. But you got to use your own common sense and logic to feel through the elements of what you're talking about when we're doing this. And again, I know I'm throwing a whole lot over. In the next session, we're going to go through the details of making this work, but I want you to develop those questions in your head. Now, you can't read the slides, so I can see that out there, but that's the actual formula, and that'll be in your slides when I hand it out to you. And that's all I have for you. So thank you for your time. outside the bus.
Thank you.
Very good. Good, good.